Can losing money in a stock be a smart idea ever? If I invested a lot in a stock and it's currently trading at a way lower price than I bought it for, should I hold on to this stock or does it make sense to sell it all off? Hey guys, this is Sandeep, and today I will talk about an investment tactic called tax loss harvesting, which is a tactic that is often used by seasoned investors to save the taxes on the capital gains from your stocks, but is not used by a lot of the retail investors in the market simply because they are either not aware of this tactic or they don't understand it fully well. Tax loss harvesting, while it sounds like a technical term, is really simple to understand with an example. Let's say I'm a buy and hold investor, and 6 months ago I bought 100 stocks of a tech company for $100 per stock. So which means I invested $10,000 in this stock. And I bought another stock in a financial company. And again, I got 100 stocks of that company for $100 per piece. So I invested 10,000 in each of these two stocks. Now let's say 6 months later, as of today, the tech company has appreciated, the stock price has gone up, and it is now 150 per piece. So basically my investment of $10,000 on the tech company is now worth $15,000. So I have a net gain of $5,000 as of now. And let's say on the financial company, it went down by 50%. So instead of $100, which I bought it for, it's now selling for $50 a share. So my $10,000 investment in the financial company is now gone down to $5,000. So I have a $5,000 profit on the tech company and a $5,000 loss on the bank. Now, if I do decide to take out my profits on the tech company in this financial year, in this tax year, I would have a capital gain of $5,000 on my account. And let's say on the on the bank, I decide not to sell that investment and I'm sitting on that stock. Now I'm a buy and hold investor, so I'd be thinking, oh, it's gone down right now, but you know what, I really believe in this bank and that's why I invested in it in the first place. So it's going to go up in the future, so I'll just hold this till it reaches 100 or above, and as soon as I make a profit, I'll cash it out then. Anyways, I don't need the money right now, so there is no reason for me to sell at a loss. And I'm a buy and hold investor. I really believe in the companies that I invest in. I always invest in it for the long term. Any idea of selling a stock at a loss is preposterous to me, and I'd be like, what? I don't want to sell anything at a loss. I am pretty sure this is a bank that's been around for 100 years now. This stock is definitely going to go up when times are good and the economy is booming in the future. I don't want to sell it at all. And that's what most buy and hold investors and most retail investors will think of when it comes to selling a stock for a price lower than what they purchased it for. So if I stick with this kind of thinking, what will happen is this year I took my profits from my tech stock, which is $5,000 capital gains. When I do my taxes in the end of the year, I'm going to have to pay capital gains tax for the $5,000. Let's say my average tax rate for the year is around 30%, which means for the $5,000 of profits that I made, I would be paying about $1,500 in taxes to the government. So how can I avoid paying a tax on the capital gains that I made from my tech stock? There is one way of doing it. If I have losses in any sort of capital investment that I have done with my money, my losses can offset the gains from this tech stock that I made in this tax year. So the IRS allows me to deduct any losses that I have from my gains, so that I have to pay a capital gains tax only on the net profit that I made from all of my investments. But hey, in my example, I don't really have a loss. I made money from the tech stock and I sold that stock and cashed in, whereas on the bank stock, I am sitting on that loss of $5,000, but I haven't really sold it because I don't want to sell it. I'm hopeful that it go up in the future. So if I think really hard on how to avoid paying that capital gains tax on the tech stock, here's one way I could do it. So I can sell my bank stock at a loss of $5,000, and then I immediately purchase all of those bank stocks back right after I sell them. Here's what this has allowed me to do. On the books, now I have a loss of $5,000 from selling the stock. and then I bought the stocks again, and then I added them to my portfolio. The buying transaction doesn't really impact the IRS because I'm not booking a profit or loss there, so they don't really care about that. But they do see that I have booked a loss of $5,000 as well on my bank stock. Now, IRS rules will allow me to offset my $5,000 gain from my tech stock with the $5,000 loss from my bank stock, and this cancels each other out, and I can show a zero net profit from all of my investments for that tax year. And that's how I can avoid paying $1,500 in taxes to the IRS for that year. And of course, the IRS realized that this is a loophole that investors can use to avoid paying a capital gains tax, and therefore they instituted or labeled this kind of transaction as a wash sale, which essentially means your transaction is a wash because you just sold the same amount of stock and then bought it right back. So ultimately, there is no change to your portfolio. All you do is just add a loss to your books so that you can show that to the IRS and avoid paying taxes on the gains from the other stocks that you had in that tax year. So what the IRS did was they added a rule saying that if you sell and buy the same amount of stock of the same company within a 30-day window, that will not count as a tax as a loss that you can show on your taxes to offset your gains. So essentially, it does not allow me to do the transactions that I mentioned in my example earlier, where I sell and buy the same amount of stock of the same company within a matter of minutes. So now, what do I as the investor do to get around this 30-day limit that is being imposed by the IRS? So one thing I can do is I can still sell the stock and offset my tax gains, and then I can wait for 30 days for buying that stock back. Now, in 30 days, the stock price could have gone up or gone down. It could pretty much have stayed the same. It is a risk that I will have to take as an investor if I want to save the taxes. So basically what I'll do is I'll compare the tax savings of selling this stock, how much in this case, in our example, it was $1,500. And I will figure out what is the probability that I will lose that much money if I buy that stock in the future. So if I think that the stock price of that bank stock is going to go up by a certain amount, so that I will have to pay more than $1,500 to buy that same amount of stock 1 month from now, if I think that that's going to be the case, then I will probably not sell the stock. And I will just happily pay the $1,500 in taxes. But if I think that the bank stock price is not going to move by much in 30 days, or even go lower in the future because of the news that's coming out about the bank or any other reasons, then it definitely makes sense for me to sell the stock, book a loss, save $1,500 in tax, and then buy the same stock 30 days from now. Another workaround that I can do to get around this wash sale requirement by the IRS is I can sell the bank stock and save the tax, the capital gains tax. And then instead of waiting for 30 days to buy the same bank stock, I can just invest right away in another bank stock, so that I can stay invested with the same amount of money in the same sector, which is the banking sector in our example. This, however, may not be ideal, because if you think you've chosen a winner in that sector and you think that that bank has a competitive edge on the other banks in that sector, then now you're forced to kind of buy the stock of a competing bank that you may or may not believe in for the future success of that particular bank. But that is an option if you are taking a more holistic approach towards investing, and you're looking at kind of your portfolio and not specific companies as such, and all you care is that your money is in the finance or in the banking sector, and you want $10,000 to be in the banking sector for the long term, then you can certainly look at as other examples, and IRS does not preclude you from doing anything like that. So the point I'm trying to make here is that if you are like me, you are a buy and hold investor, you buy stock for the long term and don't do a lot of trading with the stocks, then don't be afraid of booking losses on certain stocks, especially if they offset your capital gains for that tax year, and it allows you to save some tax on the gains that you have from other investments, and try to take advantage of the tax loss harvesting, which is what these two options that we discussed are generally called. so that you can either sell the stocks where you have a loss and then buy them after 30 days, or you look for other options in that same investment category that will kind of complete or keep your portfolio pretty much constant even after doing these transactions, while allowing you to save the tax on the capital gains that you have realized in that financial tax year. If you like this video, or if you think this will be useful for someone else, please share and subscribe. Thank you all for watching.